Hello again, and welcome back to Infinite Banking Step by Step. My name is Luke Tatum, and this is Step 8 in the series. If this is your first video, please consider going back to the beginning and starting there. We've got everything arranged in a playlist in order, and the ideas do build on the ideas in the previous videos. Last time, we took a closer look at a life insurance illustration, how to read one, and more importantly, how to interpret what you read on one. Today, we're going to be looking at using policy loans, deploying the capital that you are accumulating in your infinite banking style whole life policy to do things. Specifically, today we're going to look at a car loan and how you might use the cash value in your policy to get out of debt. Just a quick technical note before we get started. At Perfect Spiral Capital, we strongly believe in working with mutually owned, non-direct recognition life insurance companies. Both of the examples in the previous video are non-direct recognition, mutually owned life insurance companies. Now, we're going to be looking at using policy loans here. If you have direct recognition, which is very, very common in the world of insurance, direct recognition means that a policy loan will reduce the growth of your policy by some factor. The exact amount it's reduced is going to vary company to company, but it will be reduced. The illustrations, the examples we're going to look at today assume non-direct recognition, and they're using numbers from a non-direct recognition policy illustration. So just know that it's not the same story across the board. If you want to make sure you're getting non-direct recognition from someone who knows what that means, please reach out to us. We're happy to help. Okay, let's get into a car loan and how it works and how you can get out from under that car loan more quickly using your policy. Okay, here we are in Google Sheets, and I have a car loan repayment schedule pulled up. This is a $50,000 car loan. The loan interest rate is 8%, and it's going to be paid over 7 years or 84 months. Here is installments per year, which tells you that there are monthly payments going towards this loan. The installment each time that payment is made is $779.31. And you can see here, we start with a balance of $50,000 in the principal, and we're making our installments. This is how much of the installment payment goes to the principal. This is how much of the installment payment goes to interest. I've highlighted every 12th month to show when a year has elapsed. And so, as we've been discussing throughout this series, you can see there's a substantial amount of the payment going to interest. $333.33 in the case of the first payment here. As time passes, less of the payment goes to interest and more of it goes to the principal. However, by the end of the loan, I've highlighted in green when the loan is paid off, that last total, the final total, $15,462.10 goes to interest over the life of this loan. The principal is $50,000 plus that, so you're looking at over $65,000 to pay for a $50,000 car loan. For a $50,000 car. Now, this does not show sales tax, does not include any other things that may be wrapped into a loan. I like to focus on simplicity. This is, in some ways, a best-case scenario, but that is the basics of the loan. You can see it's paid in 84 months. Now, let's look at what most people do, which is to say, I will pay more on my loan to reduce the balance more quickly and pay less in total interest over time. Here's the same loan. I'll scroll up to the top. Car loan, same factors up here. This person, however, is making extra payments. I've highlighted that column. They're paying $500 extra per month on this loan. And so they're being somewhat aggressive. They're almost doubling their installment payment. Not quite, but almost. And you can see how that will have an impact on the interest paid over time. And then between the 45th and 46th payment, somewhere in there, the loan will be paid off. So you see anything after this, just please ignore these numbers. Those are all negatives because the loan is paid off. Okay. Scrolling down to the bottom, they've saved quite a bit in interest, haven't they? $8,119.45 is the total interest. It's paid off in just about half the time. Instead of 84 months, it's 45 to 46 months. And so here's their savings that I've summarized below. Versus the original loan, they've saved over $7,000 in interest, and they saved 38 to 39 months. Okay, that's all fairly standard stuff. What about if you introduce a life insurance policy? In this case, an infinite banking whole life insurance policy designed by me. This is a real insurance policy that I've built, and we're assuming that this person has been paying into their policy for 5 years. Now, it's important to know that you can do this with the insurance carriers that we work with right after you set up the policy. You can take a policy loan out approximately 2 weeks after your policy is opened. However, in this case, I'm showing that someone has been saving money in a policy diligently, which is what we would encourage. And now they are deciding, okay, I think it's time to get out from under this debt. I think I'd like to stop paying so much in interest payments to third parties. So this is their 5th policy year. At the beginning, they have a cash value balance, $27,273. A couple of quick caveats. I've filled in the month-to-month numbers here. This is not pulled from an illustration because an illustration from a life insurance company only shows annual numbers. So this number is from a life insurance illustration. This number is from the illustration. This number is from the illustration. But the other numbers are not. I have reduced the dividend out, and then I've more or less equalized the growth on the guaranteed side across this time. If you are a client or someone who is wanting to work with Perfect Spiral Capital, I'm more than happy to walk through the details of how this was calculated and how it really works using my own policies. But for now, just know that I've sort of fudged the numbers here, but it does hit the appropriate levels from the illustration each year since that data is available. Okay, so what's going on here? There's a $50,000 car loan, same as before. This person has quite a bit in cash value, and so they decide that they would like to take a $25,000 non-direct recognition policy loan and immediately put that towards the principal. So in the extra payments column, there's one extra payment. It's a $25,000 lump sum towards the original. And so what has effectively happened here is that the whole life insurance policy, what you might consider your personal banking system, has bought half of the loan. That's one way of thinking about it. So now the principal balance over here is about $25,000, and the principal balance over here on the whole life side is about $25,000. Okay, so you can see that will rapidly decrease the time it takes to pay off the original loan. 36 to 37 months. Now, and if we scroll to the bottom, that will again save a significant amount versus the original loan and also versus the $500 extra a month strategy that we employed before. And that's wonderful. You get the title to the car sooner. But don't you have a loan outstanding over here for the insurance company against your policy? Yes, you do. For the sake of a straight comparison, I'm showing monthly repayments on that policy loan. You do not have to pay policy loans monthly. You do not have to make policy payments on any particular schedule, policy loan payments on any particular schedule. The loan term is unstructured. The installments per year, it's unstructured. It's up to you. If you want to make no payments whatsoever for years, it's fine, but it will accrue interest. In this case, we're showing 5% interest, which it's variable if it's non-direct. So this interest rate could change, but it's been around 5% for a very long time, over a decade. So notice the original balance is $25,000. The principal is $25,000. And every time a payment is made, the principal is reduced by that amount. In other words, a policy loan is interest last. 100% of the payment is going towards the principal. What happens? Every year on the policy anniversary, the interest that has accrued is then added to the original principal, okay? And so it does eventually grow. The policy loan will eventually grow. However, this is much more favorable for you, the borrower. And if you are making regular payments, you're not paying 5% because your interest rate, your interest accumulation rate is reduced every time. You'll note in the first month, 104.17 is the interest accrued. Well, when you make some payments, your interest accrued each month is going down. And that pattern will continue. So you can see how it will take a little while to get paid down. We're assuming $500 per month, the same amount that would have gone to repaying the original note. So instead of this column, the $500 a month is going in this column. But as soon as the car loan is wiped out, we're going to take the $500 a month and the $779.31. We're going to combine those, okay? We're going to make it $1,279.31 and quickly eliminate the remainder of that loan. It'll take approximately 45 months to do that. You can see down here, paid in 45 months. The combined interest is $6,173.83. That's $3,500 almost on the original loan and $2,739 over here on the policy loan side. So cost savings versus the original loan with no extra payments, it saves 27 months and it saves over $9,000 versus the second strategy where you are paying $500 additional towards the principal on the original loan. It saves only about a month, but it saves almost $2,000 in interest. That's because the interest rate is lower over on the policy loan side, and because the structure of the loan is so friendly to the borrower instead of to the lender. But one more thing, note that every time you make a repayment and reduce the principal on this loan, that money becomes available again over here in the cash value with loans column. In other words, this is how much would be available in the policy to access for another loan. Now, you could loan that out for anything, but let's assume we're attacking this debt and we'd like to be a little more aggressive. Because, down here, let's see, in installment 15, month number 15, the balance on the loan is $15,552, and the policy has over $16,000 again available, right? The policy loan could be used again. You can have multiple loans out. And again, because this is non-direct recognition, it doesn't affect the growth of the policy. So let's check that out. Multiple policy loans, same exact setup. Except now they're taking a $25,000 loan, they make some payments, then they take another $6,000 policy loan, and then they make some payments, and then they take a $5,500 loan, and then they wipe it out here in month 15. So that means they get the title to the car in just over a year. And yes, it takes more time to repay the policy loan, but they have the title to the car. They are now no longer in debt to an auto finance company or a bank for the car. There is no longer a risk that their car could be repossessed if they don't make a payment. The collateral on this policy loan is not the car. The collateral on this policy loan is the death benefit on the whole life policy. So let's go down. We'll note that it takes about 44 months to repay that if they take the original car payment and shift it over to repaying the policy loan. Same strategy as the last tab that we saw. Down at the bottom, again, they have the title to the car after 15 months. It takes them a total of 44 months to repay both loans. They do have more loan principal that they've taken out because they're aggressively re-loaning from the policy, right? There's more total. It's not $25,000 on one side and $25,000 on the other. They're taking out loans faster than they're repaying them at the beginning. So the total payments made over $43,000 here, but the combined interest for both loans being completely paid off, the combined interest is $5,332.70. Here's your savings chart again. Versus the original loan, they save over $10,000 in 40 months of time. That is for paying off the policy loan. Versus the original loan with the $500 extra a month, they save over $2,700, almost $2,800 in a couple of months in total repayment time. And then versus the previous tab with using a policy loan, one large policy loan at the beginning, they still save almost $850 and they save a month in total time. That's not bad, right? Especially considering that you can repay the policy loans over any schedule. All right. The thing to notice is what I stressed at the beginning. When this loan is paid off, okay, let's go down here to month 48, so the fourth year. This is after the fourth policy renewal. In this table, the available cash value is $55,803. Considering all the loans taken and repaid, you see that number goes down as loans are taken out. This column goes down. But after all the loans are paid, it's $55,803, as though the money was there the whole time. Because in fact it is. No money ever leaves this policy. A loan is given by the insurance company on the side. It does not affect the growth of your policy because it is non-direct recognition. So there you have it. That is why you want to have this asset not in your back pocket, not necessarily just as an emergency fund, but as a tool that you can deploy for whatever purpose you need it for. It's great for an emergency fund. It's great for repaying debts. People who have several debts that they're trying to get out from under often see the value in this strategy very, very quickly because they can get debt free. Personally, we don't care what our credit score is because we don't need a credit score. A credit score is a way to prove that you are playing the game according to the rules of society. We're not playing that game. We're not playing the bank game. We're living life on our own terms, and this is how we're doing it. I hope you found this video helpful. Thank you so much for watching. I know that was a lot of numbers, so please don't be too paralyzed by all the analysis. If you have questions, that's what we are here to do. Everyone on our team is more than qualified to walk through this in detail. We are educators and not salespeople. In the next video, we're going to look at the underwriting and the application process for life insurance to answer some of the common questions there. I hope I'll see you in that video. You'll see a link to it appearing on the screen here shortly. Thanks again for watching. We'll see you next time.